The number one indicator of whether your investment succeeds or fails, and I'm sure you guys will agree with this as well, is who you're investing with, right? Rather than like what you're investing into. And so we put a checklist together of 100 questions that you can
Okay.
ask anyone, no matter what you're investing into, whether it's real estate, land, oil and gas, whatever it is, to figure out if this is the right person to invest with.
When you are.
Okay. Welcome to the Cashflow Fight Club podcast. Today, we're exploring alternative investing with someone who's making a big impact in the real estate and private equity spaces, Keshav Kolur.
Keshav is founder and principal of Clive Capital, a private equity firm based out of New York City. Since starting Clive Capital, Keshav's helped investors direct capital into properties worth over $40 million, with projections set to reach almost $200 million in just the next 5 years. This impressive portfolio spans over 300 apartment units that are under renovation and 500 single-family homes that are under construction across multiple markets. Keshav's path to real estate has been anything but conventional. With a background as a software engineer at Amazon and currently working at Facebook, he brings a unique analytical perspective to investment strategies and wealth building. So whether you're looking to diversify your portfolio, explore a new investment opportunity, or learn how hustle can take you to higher levels within the world of investing, Keshav's insights on asset diversification, risk management, and creating generational wealth are incredibly valuable.
Let's step into the champion's corner and hear from Keshav on what it takes to build and scale wealth in today's market.
Let's do it.
Let's do it.
Keshav, welcome to the Cashflow Fight Club podcast. We're excited to have you on and have a great conversation.
Yeah, I appreciate you guys having me here. It's good to finally be here. Hopefully provide some value.
Yeah, we love talking investing, all things cash flow, and we're in the real estate world, so we talk a lot of real estate. So it's always fun to connect and hear what's going on in other people's minds and outlook. Why don't we just start at the beginning and give us a rundown on who you are, what you do, and how you got into real estate?
Yeah, sure thing. So got started originally, I actually graduated college 5 years ago. Yeah, 2019. 15-hour trip flight to Southeast Asia. Figured the best way to kill our time was to read Rich Dad Poor Dad.
Okay.
That what got me interested in real estate. I didn't pick up on syndications from the book. Maybe I should have. Would have been further along, but better late than never. So that got me thinking about real estate. So I became a realtor in March of 2020. And then we all remember that the pandemic shut everything down then. But a few months later, the markets opened back up. I helped people buy and sell homes in Detroit. Then I had some cash saved up from work as well. And I figured, hey, I'm going to start looking at rental homes to fix and rent out. But luckily, before I went too far down that rabbit hole, my friend here, his dad invested into syndications before. My friend is big on Reddit. So he came across a Reddit thread where someone was talking about syndication and how this person had bought 40 single-family homes at their peak and then switched into buying apartment buildings and said that apartment buildings is just way easier to manage, whether you're an active investor or a passive investor. So I thought to myself, if it's easier, more profitable, if done right, better tax benefits, it sounds cooler to buy an apartment building than it does to just buy single-family homes. Why not do that? But no one I knew was doing it besides my friend's dad. And I still wanted to do my own research. Spent the next year just reading books and doing my due diligence and networking in the industry to figure out who I could trust, things like that. Eventually made my first investment a year later in September of 2021 into 108 apartments in San Antonio.
Was that as an LP? Or
As
did
an
you
LP. And then I started seeing the cash flow come in, started seeing the tax benefits come in as well. And I figured, hey, if I'm going to do this for myself, I might as well do it for my friends and family and anyone else who's interested, right? What's the fun of being financially free on the beach all alone? So I started a smart company, Clive Capital, in January of 2022. And our goal is to help primarily tech employees invest into private equity opportunities passively to build generational wealth and passive income. And we look for 5 things in our investments: appreciation, cash flow, tax benefits, risk, and liquidity. And every investor is going to have their own blend of those 5 and what they want out of their portfolio. But our goal is to build a portfolio passively for our investors where 10, 20, 30 investments are paying them a month, whether they're working, traveling, hanging out with family, whatever it is. So far, we've helped people invest into over 1,000 apartments under renovation and 500 single family rental homes under construction. And we're expanding into industrial real estate, private debt, and oil and gas. Again, for diversity and build a more balanced portfolio based on those 5 factors that I mentioned.
That's great. I love that. Yeah. Rich Dad Poor Dad was fundamental in our journey as well. I talked to so many people who have the same spark, whether it's real estate or cash flow and investing in general or something there. Robert Kiyosaki really told a powerful story and it's transformed so many lives. So that's great to hear another person that picked up on that and got into it. I'm not sure he talked about syndications explicitly in his book, but yeah, he definitely was pushing different cash flowing investments, being an investor and a business owner. So love to see that you do that. Am I correct that you also have a W-2 full-time job right now? Or
Yeah, I'm at Meta, software engineer at Meta right now in New York City.
that's great. Yeah, we took a hard transition from W-2 life into real estate. Just decided to go all in. But I always recommend to clients we work with or investors or anybody I talk to that if you can do it and you can overlap, it's a whole lot better journey, at least from a monetary perspective, because you have salary coming in, you have a bit of financial security. Hopefully you're able to also invest and build in parallel such that at some point you'll have enough passive income that you can be a lot freer to do what you want. From a time perspective, obviously, I'm sure you know better than a lot of us that it's a big time commitment to have a full-time job and then also another practically full-time job.
Yeah.
That's great. Where in the world are you? Are you in New York?
I'm in New York City. I'm in Manhattan, in the
Oh,
middle
nice.
of crazy concrete jungle.
Some people love it. We're in the middle of forested mountains. So it's our happy place.
Where
It's very fascinating what you have accomplished so far in
I
such a short amount of time.
yeah, thank you.
Yeah.
Yeah, I think you just asked where we were. We're in Colorado, just outside of Colorado Springs. We're in the Pikes Peak National Forest area, just up in the mountains, about 30 minutes west of there. So it's an easy drive into the city when we want some city amenities. And otherwise, we're up here with the deer and the turkey and just doing our thing. But yeah, I love, gosh, to be young relatively compared to us anyway, and compared to a lot of people that get into investing in real estate. I love the fact that you're already pursuing diversity in your investments and helping investors and doing that. Maybe we can touch on each of those. So we've done multifamily, we've done some other smaller investments, rentals, things like that, but walk us through a little bit how you go about selecting your investments. And I know you mentioned your 5 pillars, but how does that translate practically? Are you out there networking, going to networking events? Do you only work with partners that you've personally met, or what's your thesis there in your process for tracking down great investments?
Yeah, I think real estate has always been the bread and butter, and I'm sure it will continue to be the bread and butter because it's just such a stable asset class, really easy to understand, and everything can go. But besides food and water, the very next thing you need to live is a roof over your head. So I think that's always going to be the bedrock of our portfolio. But
Mhm.
then beyond that, I also recognize that, hey, everyone else has also read Rich Dad Poor Dad and is also coming into this space. Like, how can we gain an advantage in our portfolio? Like, what other investments are out there? Where does real estate investing fall short? Right? Or where could it really be improved? Like, the returns are great, right? 2x your money every 5 years, projected tax benefits, all of that. But cash flow upfront, for example, is only 5 to 10% per year for most multifamily deals out there right now. One thing that I wanted to see was, hey, is for people who prefer more cash flow rather than appreciation, is there something that can provide them that? So that's why we're looking at the debt fund. And then for example, in industrial, multifamily right now, there's a lot of supply coming online. There's a lot of distress in the market. Again, the competition is just really fierce. And some of my investors have gotten feedback that, hey, multifamily is too risky for me, just with what they're seeing in the market. So then that's why I was looking at industrial, right? So manufacturing is going to be a need that's going to stay for a pretty long time. And it's also a very stable asset class alongside with multifamily. The lease terms are 10, 15, 20 years. We're doing triple net lease. So you don't have to worry about turnover as long as you have the right tenant in there, of course. And then I would say with oil and gas, most of the things that I mentioned, except for the debt fund, the returns are on the back end mostly when you sell. And the tax benefits are great. For the most part, it only applies to passive income unless you or your spouse is a real estate professional. And in the tech industry, we do well for ourselves, but we don't always fall into that category. And we're always looking for ways to passively offset our W-2 income, passively and legally. I stress legally. So that's what led me to oil and gas, because the depreciation benefits there you can take against your W-2 income, even if you're not in the industry full time. You can passively take those losses against. I'm not a CPA also.
Yeah, speaking broadly here. Yeah.
Yeah. And the other thing is with oil and gas is that the returns are front loaded. You're mostly going to get your returns in year 1 and 2 when there's the most oil and gas in the ground. And then as you pump and sell more, your returns are going to go down. But while your returns in oil and gas are going down, your returns in multifamily or industrial, whatever it is going to pick up. That's how I think about the different asset classes and picking them. And then obviously the asset classes mean nothing if I can't find someone to work with in that asset class. So it either has to be someone that I know personally and have met personally, or it has to be someone that has a lot of social proof or is a referral from someone I already really trust. Even then, depending on how risky the asset class is, like with oil and gas, for example, I put my own money in as an LP, just like what I did 4 years ago when I first got in, so that I could understand it, not risk any of my investor capital, show proof of concept that, hey, this works, and then take it out to my investors.
Yeah, those are some great tenets to be basing your investment business cases off of. I would like to talk a little bit about oil and gas, if you don't mind, pardon the pun, but drilling in a little deeper. It's an asset class that we're broadly familiar with, we're very interested in, but we haven't really explored. We haven't explored it on the podcast either. So I think it'd be good to discuss a little bit about that investment. You mentioned returns being front loaded. Is there typically, like most syndications, a fixed investment period? What are the broad return profiles and things like that?
Yeah, it wouldn't even be a 101. It'd be like half of a 101.
Okay.
Whatever that.
Fair.
I'm still learning myself. There's a lot
Sure.
of ways to invest in oil and gas, just like there is in real estate. Invest into like the drilling equipment, for example, the company that's actually drilling. You could invest into the land through mineral rights, like working interests and non-working interests. The strategy that we went after, because we wanted the tax benefits, but we wanted to minimize the risk of a dry hole, buying some land where there wasn't any oil and gas, is in oil and gas, there are what are called the equivalent of realtors in real estate.
Mhm.
And these landmen track the transactions of mineral land, how it exchanges. Once one of our landmen tells us that, hey, Shell is buying up a bunch of these mineral land parcels, hundreds, if not thousands of acres, we know that they know that there's oil and gas to be found there in the area. So we go in and buy land near where they're buying land. If they buy 1,000 acres, we might try to get in and get like 50 acres, like nothing crazy. Because we own land right next to them in that area, as long as oil and gas is drilled within, I think mineral land is divided up into like squares. As long as oil and gas is being produced from that square and you own land in that square, you get a portion of the revenue. Even if the exact square inch that you own isn't being drilled on, as long as you're in that square, you get the revenue. So that minimizes the risk of you hit a dry well, there's no oil and gas to be found, right? You're increasing the likelihood. Then you're going in with a big company, they know what they're doing. And I believe what we bought was a non-operating work interest. I might be wrong here, but a non-operating working interest so that we could get the tax benefit, the losses we can get against our W-2 or any type of income, really. So every 100K invested on this deal, I got to write off 80K off of my income in year 1. On top of that, return profiles, years 1 and 2 is typically like percent. I'll say 30% of the lifetime production of oil and gas is going to come out in year 1 and in year 2. So 60% between the 2 years.
Okay.
Then it's going to decrease as time goes on. And then that's like from a production perspective, right? You're going to produce 60% of your minerals extract 60% of the minerals in your first few years. Depending on what the price of oil and gas is doing, oil right now is down, I think, $65 a barrel, something like that. Natural gas, I don't track natural gas as much. I don't know, somewhere between that $2 to $4 range, a pretty broad range. But depending on where those are at, this deal, when we did our projections at least, and not crazy numbers, I think I was using $75 a barrel on oil and $3 per million cubic feet of natural gas. We're looking at like 25 to 30% IRR on the returns. Yeah. Again, most like the deal's great. We bought the land at the right price, but also because you're getting money back quicker. And once you factor in the tax savings, that it just juices your return even more.
Yes.
Yes, we're big believers in the power of depreciation and in taxes. I think oil, I don't know if you touched on this, but like in residential real estate, multifamily, or let's just say capital equipment type depreciation, there's a recapture at the sale. Is that the same in oil, or is it just a pure depreciation write-off? It's more of a
I would
energy
imagine
credit.
that it exists, but our strategy here is to hold the land for 30 years. So we would get past that, 27-year period in real estate at least. And the reason there is you're going to get your capital, your principal back within the first 2 years. And at that point, it is pure mailbox money, right? You can redeploy that capital and your cash on cash technically is infinity. You have no capital in the deal, but you're still making returns.
Yeah, we love those kind of deals.
Yeah,
Great. See those in our land business. We have some instances where we kind of work that way, but yeah, that's great. Let's pivot into the fund concept a little bit. I'm not sure everybody knows exactly what a fund was and what a fund is and how it operates, but maybe just broadly, the 101, kind of what is a fund? And then we can get into how you nest investments within that and work with different investors in your fund.
So specifically, I'm using a fund of funds, just to be very specific with the terminology. And there's kind of two types of funds that you might see out there. I'm not a lawyer either, I should say that. There's a 3C1 fund, and that's what my fund is, where you are not operating the underlying asset. You're purely allocating capital into the different LLCs that own the assets. There's a 3C5 fund where if you're a big operator, you might open a 3C5 fund, and that fund will acquire 5,000 multifamily units over the next 5 years, rather than doing one-off syndications. But the fund directly owns the assets. Whereas in our case, we don't directly own the assets. We invest into the LLC as any other limited partner would, and then the LLC owns the assets.
Okay.
Yeah.
Typical, what people are usually used to is, hey, let's say I want to invest in multifamily and I have operators that I really like. You're going to have to sign up on the investor portal for both operators. You're going to get K1s from both operators, right? Initially, you're going to have done your due diligence on both operators as well. That's only multifamily. If you want to diversify outside of that, let's say you have 5 asset classes and 2 operators you like in each, that's 10 operators in each of that, 10 investor portals you need to sign up on, 10 K1s you're getting. So a fund of funds streamlines all of that, where for me, I have a customizable fund of funds. I like to bring 5 to 10 investment opportunities to my investors every year from all these different asset classes I mentioned: multifamily, value add, ground up built-to-rent construction, industrial real estate, private debt, and oil and gas. So I can have all of those opportunities in there in that same portal. So that's one login, right? For the portal, as long as the taxes work out, like sometimes you might not be able to mix oil and gas with real estate, but for the most part, you can get 1K1 for all of your investments through the portal. And then again, lastly, you as the investor don't have to go out finding these 10 different operators. That's what my job is as the fund manager, to go out and vet and do my due diligence. I come back and centralize all the information in this portal that I can spend my time just out there networking, finding the next hot asset class, whatever it is, right? Small businesses, for example, or venture capital. I can focus on that and bring it to my investors, rather than my investors having to go out and find a different operator and vet them in each asset class and have to learn about the nuances of each asset class.
I do have a question. You mentioned earlier that the investors, they also will have to perform their own due diligence on the asset class and to vet the operators. Do you provide guidelines for them or tips on how they can do that?
Yeah, I guess I said that they would have to do that normally if they were out on their own.
Oh, okay.
But I'm saying with me as a fund manager, I do all that work in between, and I do
Got
more filtering of who to bring in. Even then, I'm never going to say that, hey, completely remove the risk here. Nothing can ever go wrong. You should always recommend to investors to do their own due diligence.
Yes.
But we take away as much uncertainty and try to educate our investors as much as possible. And yes, I forgot where I was going with this. I don't want to keep rambling though. So
Yes, and that's one of the benefits, right? To put your investments dollars in a fund like this, because then you have done the upfront work, and people can actually trust that layer of protection that they have.
exactly. Yeah. I would say the other benefit is that like it's a customizable fund. So if I have 10 opportunities a year, you can say, hey, Keshav, I don't like opportunities 1 through 5. I like opportunities 4 through 6. I'll put my money in there. I'll get returns and tax benefits and all that for only 4 through 6. I'm going to skip on 7 through 10. So you can pick and choose like a buffet, which investments you want and which ones you want to sit out.
Yeah, I love that concept. I'm going down into the weeds probably, but I'm just curious how it works from the fund perspective. Just from an example of, let's say I'm signing up in there and there's a multifamily deal that's a 5-year hold period. You mentioned the oil and gas is a 27-year longer year hold period type thing. Like, how does that filter itself out to me with all these overlapping deals and returns and things like that? I guess that's where my disconnect is mentally.
Yeah. So like at a fund level, you have to sign a PPM for the fund saying, hey, I'm in,
Mhm.
that's for this fund. And then the PPM will say, hey, here's what this fund is going to broadly invest in, right? Like it's going to invest in multifamily, oil and gas. It won't do crypto and hedge funds, whatever it is, like a buy box. And then on the deal by deal basis, you will fill out basically like a subscription agreement. Hey, I'm going to invest this amount and these are the terms that I'm getting, right? And then we'll specify on a per deal basis that deal disclosure document. This is the specific asset, the risks, these are the returns, et cetera. And then after that, it's really more of a back office problem that you're describing. So we just have to keep in our books track of who invested in, what are the returns coming in, and then distribute it out to people. The platform that I'm using, Avestor, makes it a lot easier. It's a tech platform, and so they have a lot of this already functionality built in there where you don't have to worry as much.
Okay. Yeah. You mentioned a bit ago searching for hot asset classes. What do you see the market right now? So we touched on, or you did, multifamily. There's obviously a housing shortage nationwide, market to market. That's a little bit different. It plays out in terms of rental versus purchases, affordability, the classes of homes. But how do you see broadly the rental markets, the purchase single family home market, and other asset classes? What's maybe things people should be looking for here in the next 12 months ahead?
Yeah, I think multifamily will have opportunity with the distress that's coming up, depending on how much the Fed cuts and stuff. But definitely opportunity in multifamily as these loans mature. And then across a lot of other places in the country, I know the 500 homes that we're building are along the coast in Louisiana and Alabama. Our insurance rates have doubled on a per unit basis.
Yeah.
So for people who are less experienced, and there's a statistic out there that I think 70% of syndicators started in the last 5 years or something, right? All these coaching programs that came up, someone who was a dentist last week is now buying a 100-unit apartment building this week.
Right.
Some people are doing well and then other people are getting burned. So there's multifamily opportunity for sure. And usually with multifamily, we target like a 15 to 20% IRR, somewhere in the middle, more realistically, right? Like 16 to 17%. And with development, I think development right now, it's tough with interest rates where they are and just uncertainty in capital markets. People just prefer cash flow rather than something as appreciation heavy as development. There, we typically target 20 to 25%. And if you're buying in the right places and at the right, if you buy the land and you're able to execute, it's a great time to build because you have less competition, right? Labor pricing comes down, materials pricing comes down, and you're not competing with other people as much for that. And then the housing supply, like you said, put a dent in that. Beyond that, let's see, private credit is having a good moment right now just because borrowing costs are so high. So that's another reason why we like that. And
Just maybe define private credit
or
how you
private debt,
mean
I
it.
mean,
Is that
private debt.
okay? Like hard money lending or
Yeah,
what
just
aspect?
lending out. Mostly it's real estate backed. So lending out to folks who like fix and flip or fix and get your
Okay.
money back in like 6 to 12 months. The big thing we like there is just the shorter hold period, right? You can be in and out of these loans within a year or two rather than being locked into a 5-year syndication. Let's see what else. I think, but like in general, in real estate, it's getting a lot pricier as more people like us read Rich Dad Poor Dad and we pile in. Or that's why I like oil and gas. It's still less well understood. That comes with its own risks, but I think that's a part of being a savvy investor is beating the crowd, understanding something before everyone else understands it. And then another one that I really want to explore, probably in 2025, is private equity, like business acquisitions, right? Like things like that. There are, what was it, 10,000 baby boomers retiring every day. And a lot of these are small business owners. If you can acquire these companies using SBA loans, and I haven't done this, I'm just speaking from what I've read on LinkedIn at a very high level. But put an SBA loan on there, get some seller financing, and apply economies of scale, things like that. Integrate tech into there because sometimes the older generation, they're not as tech savvy, right? Try to automate as much as you can and increase your returns that way. Like that's a space that hasn't been tapped into as much as real estate has. So
We've danced through some alternative asset classes. How do you see that stacking up against the traditional 401k stocks, bonds that people put into?
yeah, industrial deal that we're raising for right now, I'm talking to my investors about it. One of my investors said, hey, if I can't get the tax benefits, then it might just make more sense for me to put it in an index fund. So I was crunching some numbers using VTI and its returns over the last 10 years. So from 2014 to today, it's achieved about 11% IRR. Assuming you just buy and hold, you're not doing anything fancy, 11% IRR. And that's with all the volatility of the stock market and the risk that comes with it and the lack of tax benefits. And our industrial deal, we're projecting a 14 to 16% IRR conservatively. The big reasons that I like alternatives to the stock market is diversification into different asset classes. The stock market, you might have different sectors like manufacturing, energy, tech, etc. But if one stock goes down or one index goes down, more broadly, the entire market goes down. Anytime there's a war, anytime another country is going through some political or financial or social turmoil, our stock market always gets hit, right? What does another country's debt crisis have to do with my portfolio? On the other
It's a very emotional place to be. Many people trade on emotions rather than logic and found the information. And that's where the top traders can make their money because they know there's going to be these swings in the market just based on fears or herd mentality or something. And yeah, it's definitely an interesting place to be.
Yeah. So I don't like that volatility or that I call it like a monkey brain almost, just like buy and sell with no real justification. And then the returns that we're achieving in private equity, these alternative investments in general, just outdo your general index fund, mutual fund. There are no tax benefits in the stock market that aren't in alternative investments. And I'd say the other big thing is just transparency. For me, it's a lot easier to understand how these businesses operate. Like I can understand, hey, this apartment building's bringing in $1 million of revenue every year and the expenses are 500 grand. That means its profitability is 500 grand. And if it trades at a 20x multiple, that means it's worth $10 million, right?
Very good.
But I work at Meta and I couldn't tell you how Meta's stock is valued. One day it's up, one day it's down. And our business model, frankly, is just really complicated, right? It does well, like our profit margins are crazy, but I couldn't tell you, here's why we're doing as great as we do. So those are some of the reasons and I would say the last thing is you don't have an advantage over other people. And if you do, you'll get jailed for it with insider trading.
Yeah, sure.
And so the only reason, but in these alternative investments, you have relationships with people. You can trade on insider information without getting jailed, right? If you hear through the grapevine that Disney is opening up a new theme park, you can go in there and buy all the land around it to go build homes and other businesses, et cetera. So that's the other thing. It's just I'm investing into a hedge fund, and there are hedge funds out there that are doing crazy well for themselves by just having an edge over the market. That's the only scenario I would put money back into the stock.
Yeah, it makes sense. We've been out of the markets since pre-COVID, and since we got heavier into real estate, we have self-directed IRAs and put into different asset classes and just avoided the stock market for a bit for most of those reasons. And the returns definitely can be better. You have a lot more control over who you invest with. Exactly your point. The boards of Facebook or Meta and Apple and Amazon. Yeah, you don't You can sit in on the shareholder meetings, you can read the shareholder minutes, but yeah, I don't pretend to know what the meta ad revenue strategy is and how it's going to bring over, or what the user acquisition, or not acquisition, but user growth prospects are, just all of those kind of things. It's really gambling at some sense, right? Unless you're Warren Buffett and you're able to meet with the heads and understand the strategy and really dig into the balance sheets, then, and he doesn't even go into the tech world because of exactly all these reasons, right? He doesn't
Yeah.
understand how things are valued and all of that. So it is a lot like gambling, more so than exactly your point. Okay, if I have a property or maybe 5 that I need to look at, you can understand, okay, rent growth, is this a good estimate? Is it cash flowing positive today? What are the likelihood of further property tax increases? There's a lot of variables that go into underwriting a multifamily deal, but it's far fewer than looking at Tesla and trying to figure out what's going to happen here in the future. So
Exactly.
that's awesome. A little bit more about your fund then, or your fund of funds, just to be precise. Like, what, from an investor standpoint, what are the minimums? Is there a standard hold period? How does that work for people that want to invest with you?
Yeah, our minimum is 50,000, like pretty
Hmm.
standard across most syndications. And then we do reward our bigger investors. So right now, at least, we've set up different classes at 50,000, 250,000, a million, and 5 million. With the
Okay.
goal being like, hey, these are major benchmarks. If you cross them, like, you'll get preferential returns for obviously investing bigger capital. Thus, hold
Just
periods.
to dumb that down a little bit, maybe.
Yeah.
So different investors are, let's say, incentivized for higher amounts of investments with a better preferential return, which just means I don't want to say guaranteed, but your threshold return can be higher. So for instance, and I'm not sure how this works in a fund of funds, we can certainly explore this, but like in a typical syndication, which I'm more familiar with, the partners either don't get paid or get a limited payout if the deal is not reaching a certain return, and typically 7 or 8%. And then, or that's the preferential return. Is that a similar setup in the funds, and how you've set up the different class of investments?
The fund itself comes in as one big LP, like one big limited partner. So at a fund level, there's going to be a preferential return with the
Mhm.
operator still, right? At your fund level, like between myself as a fund manager and my investors, I can apply that same pref, or I can just keep it simple and say, hey, I'm just going to take a whatever, 5% of whatever comes in without any hurdles. So if we hit it out of the park, great, it's 5%. If we don't hit it out of the park, it's also 5%. From our perspective, we found that from a back office view, like that's a lot easier to not have to calculate prefs and everything. If you can just say, hey, every $10 comes in,
Sure.
9.5 goes to the investor, 50 cents comes to us. And the other thing is also that I think legally what I'm seeing this world is that some states, some jurisdictions are cracking down on performance-based hurdles, meaning typically, again, we'll say 9% pref, then a 70-30 split. Then maybe if you do more than a 20% IRR, it's a 50-50 split, right? For a fund of funds, they're saying if you have that last hurdle, it might incentivize you to take bigger gambles to try to hit that benchmark. So there's some states where they're cracking down on performance-based fees. So it's
Yeah.
much easier to say, for me, much safer also, just to say, hey, regardless of how this does, I'm just going to take 5%. Yeah. But the fund, it does get rewarded preferential terms at the fund level because we are a bigger investor.
Sure. Yeah. You're bringing 5 million into a deal, or a million, or whatever. Yeah.
Yeah. So at the end of the day, our investor returns aren't significantly impacted at all, compared to as if they were to just go directly to the operator.
Okay. And is there accreditation requirements in fund of funds, or how is that?
Yeah, you can have a 506B fund, you can have a 506C fund, and this one that I opened up because we're talking about it, it's a 506C fund. So accredited investors only for the.
Okay. And then a hold period, is that somehow predetermined? Like I was mentioning earlier, you have these overlapping investments with different time horizons and stuff. Is that customizable for people, or is that just a fixed block?
It's just based on whatever you're investing into, right? So if the multifamily syndication you decide to invest into has a hold period, that's your hold period for that investment. Then 6 months later, you decide to invest into oil and gas and the hold period is 27 years. Then for that investment, you're going to get distributions for 27 or 30 years or however long.
Years.
That makes sense then. Everything is clear.
Exactly. Yeah.
Yeah, that's where I was having the disconnect. I was trying to think of. So so if I were to invest, let's say $100,000 and I go into your menu or your portal of options and I want this multifamily investment and I want this oil and gas investment. Do I then also allocate funds, like I say 50-50 or 70-30 or something like that?
It's up to you how you want to allocate the funds. Yeah.
Yeah. But I intentionally go and say, I'm going to put 25K into this oil and gas deal, and I want the other 75K into this multifamily deal.
Exactly. Yeah. Totally customized.
Very straightforward.
And if people are very intrigued and would like to get in touch with you, what's the best way to find you?
Yeah. My LinkedIn's pretty good. It's just, I'm one of the only Keshav Kolurs out there. So I think I get the LinkedIn over, but I can if I have it.
We'll get in the shout out as well. Yeah.
Yeah. And then the other way is it's important to do your due diligence when you're getting into these investments, because I would say the number one indicator of whether your investment succeeds or fails, and I'm sure you guys will agree with this as well, is who you're investing with, right? Rather than like what you're investing into. And so we put a checklist together of 100 questions that you can ask anyone, no matter what you're investing into, whether it's real estate, land, oil and gas, whatever it is, to figure out if this is the right person to invest with. And then we have a 5-minute read about why you should invest outside the stock market, some of the benefits we talked about, but also including data on performance of the stock market versus privately owned real estate. And if I haven't bored you to death, then there's a 20-minute read that just goes a little bit more into depth about, again, the benefits of investing outside the stock market.
This is great. So this answers very clearly my question earlier. Like, you provide also education for people. You provide an entryway in how to ask questions, what kind of questions to ask. Many times people don't know what they don't know, and they don't know what to even ask. So that's wonderful to hear that you provide that.
Yeah. Oh, and the website for that is clivecap.com/alternative-assets.
Okay. Yeah, we'll get that in the show notes as well. But you bring up a very important aspect of, I think a lot of times, I know I speak from our own personal experience. So when we got into multifamily or wanted to get into multifamily, some of our early deals, we didn't do enough personal due diligence we were in a community of people doing multifamily deals. And so we had met many people personally, but we didn't necessarily dig into too much depth as to the lead operator, the sponsors of certain deals, their track records, their experience, be it directly in this role or others. And we were excited to get in on some deals. And fortunately, those early deals really performed well, but we did have the revelation and realization that it is super critical. We have since been in other deals where you get to compare how different sponsorship teams perform, right? Some people are hyper communicative and they're really giving transparent information and keeping you abreast of what's going on. Where are we with improvements and renovations? The other side of the coin is some people are very protective and they're not sharing financial information or very limited financial information. And they get defensive if things are happening there. It is crucial. It's also very hard to pre-vet these certain types of scenarios, because until you go through crises with someone, you almost can't assess how they're going to respond. Now, I would argue here, as we said in 20, there's probably a good data set. Like, people should, I don't know on your checklist, but I would imagine there's some element of speaking to people who have either partnered with or invested with these people before, right? And get their feedback. Hey, I love the communication style, or this whole period from 2021 to 2023, where, as you mentioned, deals are getting distressed. How are people responding to that? Are they leaning in? Are they opening up? Are they shutting down? All those kind of things are really critical when you're putting 5 or 6 or even 7 figures of investment with people. Yeah, that's a really critical component of investing with anybody, be it directly in a syndication or, as in your case, like a fund of funds. And even you mentioned, and I'll just reiterate here, it is important, even though you are vetting people, it's good for people to do their own homework to some degree and understand as well. But it is a challenging aspect of deals beyond the numbers, right? The numbers are the numbers. You can look on a slide deck or a PDF or whatever and see how things look. You can make your own assessment, like, oh, okay, I think rent growth looks like it's in line, or they're being very conservative on their expenses or whatever. But people's character, that's a hard thing to dig into. There's not a Yelp for syndicators out there, which might be an idea for you in the tech world to come up with a rating app for different operators and syndicators.
That's true. Yeah. And unfortunately, you only find out those important qualities about someone when things start getting rough. And then by that time, it's for your capital, at least it's too late, but you're going to have some investments that go bad over your lifetime. So I think the important thing is to learn from them and then don't let that stop you from investing again, right? Pick yourself back up and get back into the game.
Yeah.
Yeah. This is the classic mistake in the stock market, right? People sell in a panic and then they miss buying in the opportune moments. And so they're exactly in the opposite ends of they're buying high and selling low. That's what you don't want to happen as well in whatever investment you're making. But because you have to average things out over time, right? It's very unlikely, to your point, that we're going to have 100% home runs in all of our investment picks. Another important element of diversification. I'll love to see that in your fund of funds.
Yeah.
We've enjoyed having you on the show. This has been educational, enlightening, and love what you've got going on. We typically end our shows with expression of gratitude. So we certainly thank you for coming on the show, but any one or few people that have really been helpful along your journey that you'd like to express some gratitude to?
Yeah. To start off, I appreciate you guys having me on the show. It means a lot. And I know we've been connected for some time now, so it's good to finally collaborate again. I would say definitely parents for just instilling good work ethic and a good head on my shoulders. To, like you said, to be able to think about investments at an age like this. And then to just my mentors and partners in the space in general, like my build-to-rent partner, Andy McMullins, for example, just taking a risk on some 23-year-old, bringing him on, letting him take a crack at underwriting and putting pitch decks together and stuff. Yeah.
Mentors, parents, those are all great ones. Well, Keshav, thanks for coming on the show and wishing you all the best. And we'll make sure and get contact information and links to your site and stuff in the show notes. But thanks again.
Yeah. Thank you so much, Mike and Ligia.
Thank you. And we wish you all success.
Yeah, you as well. Looking forward to staying in touch.
Likewise. For those of you joining us today, we hope you enjoyed this time in the Champions Corner as much as we did. Got some awesome takeaways, and most importantly, will take action to continue living your best life and maximizing your potential. Mindset is such an important aspect of life, and when coupled with action, delivers undeniably powerful results.
Please subscribe to the podcast to hear from more great guests and get the latest mindset mastery insights and cash flow matchups.
Again, thank you so much for investing your time with us, and we look forward to seeing you next time on the Cashflow Fight Club podcast.